Hey guys, what's going on? This is Carlos, CEO of G.A.R Capital. Hope everyone's having a great evening. So, this is we don't do this every quarter, but Q1, obviously, January to March. So, we're going to do a investment seminar. You guys have questions. I'm going to talk about a couple of things, kind of break things down in the sense of how to make it a little more sense to you. I know there's a lot of jargon out there, Federal Reserve, QE, liquidity, bailouts, bonds, credit spreads, all that jazz, right? A lot of stuff. So we're going to kind of break this down, uh, exactly how to look at your money, think about it moving forward. Is this a crash? Is this a generational buy of a lifetime? Is this a time to go all cash? Is the economy over as it is? Is it the end of capitalism? I know there's a lot of questions. So what we're going to do is just kind of break this down, answer some questions here and there, and go that way. So make life easier. Well, again, we're about to start now. It is now 8 p.m. Welcome aboard to our investment seminar. So I'm going to speak a little bit, kind of talk about what's going on in the markets, why are things going the way they are, kind of put things into context, break it down so you're not just full of fear from the media. You're not in a point of shock. You're not in a point of, I don't know what to do, or should I just throw my hands up and just give up? Because that's not what we want to be. So let's go ahead and kind of break down where we are. So, of course, emails are coming in hot, nothing new. Anyways, so I think I don't need to be on this webinar to tell you that the markets are falling, right? Duh, pretty easy. I wish I could mute this. Let me see if I can mute. If I just get emails, guys, just ignore it. It's a pain in the rear. Okay, so we know that the markets are down, duh. So what do you do about it? What do you do here? So the reason things are moving down and why they're moving down so quickly is kind of I don't want to put it too simplistic, but it's really pretty not just one thing, but many things. It's kind of like saying World War II was started because Pearl Harbor was hit. It's more than that. So what do I mean? Well, coronavirus is not the only reason the markets are falling. There's a little more to it than that. We know we hit all-time highs, I believe, February 19th of this year. All-time highs in the Dow. If we brought up S&P 500, which I can just bring up here, SPX, which is the S&P 500, and you could see here on a daily chart, literally the highs was 3,300, almost 3,400 points. Now we're at 2,237. That's a really big fall. You're talking about almost a 34% fall, the fastest 34% fall in the history of the stock market. So did companies become 34% less valuable in a month? Not really. What you got, I'm going to break it down here, is that you had a lot of hedge funds and a lot of investors that borrowed money very cheaply. Thank you, Federal Reserve. And they got more speculative. They started doing more buying stocks thinking that it'll always go up. Well, they were right for a long time. We had a bull market for about 11 years. So mix in cheap money from the Federal Reserve to stimulate the economy and rampant speculation. This is what you get. The slightest part of trouble, because people started buying stocks on margin, they get margin called, meaning they need cash to cover their positions. Well, in order to raise that cash, they have to sell assets. This is why gold, for example, and I'm going to bring up here GLD so you could see this is a gold ETF. You would think gold would be soaring right now. Well, people made money with gold. They had to sell their gold in order to cover their stock losses. So what you're getting here is a mass liquidation. So think of it as a fire sale. You lost your job and you need to pay your bills. And you're trying to sell everything. You're selling your Pokemon cards, your basketball cards, your collectibles, your assets. The kids maybe next. That's what you get. You start getting desperate. So you're talking a great company like Apple, who's had great earnings and has done great things, great cash flow, great balance sheet, all that. Are they 33% less valuable in a week? Probably not. But again, you had a lot of Apple shareholders that had to sell their most profitable stocks in order to cover their margin calls. So you just get that wave of selling, circuit breakers and all that stuff. So everyone got pretty much caught with their pants down. So what do you do? How do you play this, right? What are you thinking? Oh, okay, what do I do here? What do I do here? Well, there's two questions, there's two answers to that. Number one, I'm going to speak to you as an individual that you still have a job. And if you still have a job, awesome. If you still have a job, this is a time to really kind of audit yourself and look at, okay, I've talked about this in the personal finance course. Do I have 3 to 6 months of expenses? If you have 3 to 6 months of expenses right now in cash, like I talked about in the personal finance Udemy and our YouTube videos, then you're kind of sitting pretty. You're not really waiting for the government to help you out, which is fine. Again, I want the government to help people out. That's what I want. But again, you're not really focused on that. You're not like, oh my God, I need that. If you miss 2 paychecks, you're not dying. You have savings, you're out of debt, right? You have a job and you're doing fine. So right here at this juncture, if you have a 401k, you're probably freaking out. You're like, oh my God, my 401k is down 33%. Well, unless you're retiring within the next 10 years, you really don't need to do anything. You just kind of keep things as is. Keep auto depositing the way you have your retirement. Remember, it's a tax benefit, and also you get matched from your employer if you do, fingers crossed. So you kind of don't even want to look at it. I kind of recommend just don't look at your 401k. You're not going to use it anyways. If you were up 33%, I tell you that inversely. If you were up 33% in a month, would you cash out? Probably not. So again, this is a retirement account. It's not making money tomorrow account. Your brokerage account, where you have your investments, if you have one. Again, do you need the money today? If you need the money to cover everyday expenses, this is your savings account, then I can understand where you're cashing out. But here, you're not selling anything. You don't sell on the lows, just like you don't buy at the highs. You're doing it backwards. So again, emotions get involved. As long as you don't have a margin call, thankfully, then you're going to be fine. I mean, think of it this way, guys. You're betting on America. Really think about that. If you think the coronavirus is going to be the end of civilization, then basically your stock portfolio is meaningless. You're going to be on the street throwing rocks at each other to fight for food. So again, your shares in Apple are meaningless. So kind of think of it that way. I mean, is this the end of United States civilization as we know it, or is this just a really, really painful, small, temporary thing? Small, I mean time-wise, not small in it's in severity. Again, this will pass, guys. We have been through many things as a country. We have been through World War II, Pearl Harbor getting hit. We beat the Nazis. I'm talking about the United States. The Cold War, beating the Russians. We have gone through Cuban Missile Crisis. We survived that. The Vietnam War, we survived Watergate. We survived the 87 crash, the dot-com bubble, 9/11, hurricanes like Katrina and Hurricane Andrew and all those, the 2008 mortgage meltdown. We've survived it all, and we're going to survive this, guys. The country is not going to end tomorrow. This country is not going to end in 5 years. We have a lot of money. We're printing a lot of money, yes, but again, at the end of the day, guys, we're still the greatest country economically on planet Earth. And they need us as much as we need them, meaning other countries. So again, unless you plan to think that the world will end and we're going to be going back to the barter system and the Bronze era, the Bronze Age, and we're just going to kill it and fight each other over food with pitchforks and knives, okay, then I can see your point. But we're not going to be there. What you're going to get is a lot of people who played with fire, meaning who were over leveraged with debt, who started playing too much speculation. A lot of these real estate guys, a lot of these stock guys, a lot of guys who are heavy levered. These hedge funds are probably going to be liquidated, meaning they're going to have to sell everything. You're probably going to get some bankruptcies. I wouldn't be surprised if cruise lines go bankrupt. They're not exactly essential. Airlines are going to be probably bailed out, but which one? Are you going to pick and choose which one you think is going to be bailed out? Hell, the politicians don't know which ones are going to be bailed out. Do you really want to pick and choose who you think is going to get bailed out? I don't want to play that game with my money. So again, car companies, Ford has money to cover, but how long? GM probably has money to cover, but for how long? They don't have the consumption. No one's buying stuff. Retailers, how many retailers are going to go out of business? Macy's was already on life support before this. Imagine now, they're probably going to go bankrupt. Again, bailouts, separate thing for bailouts. But again, if you're thinking the world's going to end, then I'd understand you want to sell. That makes sense. Another thing is if you need the money, then you probably want to sell, and that's okay. But if you're thinking long term and you're thinking about your wealth over time, this is the time in your mind to start positioning yourself. And we're going to get through that in here in a second on how to position yourself and what to look for moving forward, because in a sense, this is a huge Black Friday sale that's been lasting for a month. And I know you guys know what Black Friday is because you guys shop on Black Friday, billions of dollars buying the same freaking TVs every year. And I've seen it. So yes, it's fine. And I know you guys have a ton of questions, so don't feel bad. I'm going to answer each and every one of you guys. So I just want to go ahead and explain, and I'll answer some questions as we go. I have your chat room right here with these questions, and I got you guys. So that's where you are in that sense. Again, if you think the world's going to end, fine. I would say stick with what go ahead and sell what you got to sell and just hunker down, buy ammo and guns and whatever. hold down the fort. I understand. But if you think America is going to continue thriving, and yes, this is a temporary thing, again, sucks. I know, very severe. I don't take that lightly. People losing their jobs and getting laid off. I really wish you guys the best, and I really hope for the best. But again, 9/11 was bad. Dot-com bubble was bad. 87 was bad. 2008 recession was bad. A lot of bad out there. A lot of bad happened. So again, don't feel too discouraged. I mean, I know it's a lot of bad news out there, but again, don't get too discouraged because this will pass. That I can promise you, this will pass. I just don't know when, but it will. Let's go to the next side. Let's say you just got laid off work. Now we're going to go to the other side, and you're talking about your investments, right? Okay, you just got laid off work. You don't have the emergency fund. You're kind of in dire straits. So I'm going to be talking to you now. Right now, take a deep breath. This isn't your fault. There's no one to blame here. This is just a horrific time in your life, and you're going to feel very beaten down. I totally get it. The best thing I can tell you guys is don't beat yourself up. Don't blame yourself. This isn't your fault. It's not a bot fault. The president, it's not his fault. It's not Congress's fault. It's not your fault. It's just we got caught in a horrific storm of this virus. Best thing you can do right now is really take a look around and be grateful for what you do have, not what you don't have. Now, again, that doesn't mean much when you're not making a paycheck. I agree. But depending on where you work, again, I don't know your situation. If you have a furlough, again, you still have health insurance. If you just got laid off, do you still have health insurance? That's kind of important. Most important thing is your family, your health, and keeping the lights on. So kind of another thing I will do here, if you don't have a lot of savings, guys, and you have some investments, this is a time to cash out. I know you probably think to yourself, but my investments, you need to eat. You need to keep the lights on. You need to pay the bills. Your investments, throw that away. You just have to sell. I mean, it sucks, but you'll get back in. There's other opportunities. If you have your savings account, this is the time to use it. That's an emergency fund for you. Another thing too is kind of stay out of debt. But again, if you need to use it for essentials, yes, if you need it for food, you're gonna have to use it. Fine, I can understand that. So what do? There's a lot of jobs out there that are hiring. I mean, I think Instacart is hiring. I think UPS is hiring. Tons of places that are hiring. Doesn't have to take a look. I know with the quarantine stuff is a little difficult, but again, there's other opportunities there. And if you can kind of save some money, do so. The best thing I can tell you guys, if you have a landlord, if you're renting, if you have a mortgage, call your mortgage company today after this webinar or even during the webinar. I don't care. Be on hold. It's fine. Call your mortgage company and ask for a forbearance so they can move your payments over to the end of the loan. And your landlord, you have to tell them, hey, listen, man, I just got laid off due to this Corona stuff. I need some help. Can you just roll me to the next month or whatever until I get on my feet? They're gonna have to understand that this is for everybody. This is not just you getting fired because you did something dumb. You literally got laid off because it was out of your control. If you have credit cards and you have credit card bills, that should be the last thing on your list. But give them a call. These creditors, your car payments, whatever, give these guys a call, guys. Right now on the phone, call them, tell them your situation, that it is not your fault, that this is just a situation that you got laid off, the coronavirus stuff, you don't have a job, you don't have income, and that's okay. Again, that is okay. We're not here to blame you for anything. We're not here to say, oh, you didn't prepare, that's your fault. No, man, that's not helpful. What you need to do is get on the phone right now with these guys, your utilities, cell phone, credit card, car payment, insurance, your home, your electricity. I think I said that already. Your mortgage, all that stuff that needs to be taken care of now, guys. Don't wait toward the end when your credit is ruined. Do it now. Do not feel ashamed to make that phone call. Do not feel ashamed. Don't feel that, oh, I'm a loser. No, you need to fix this now. And you will get past this when you get your job back, if you get your job back, or another job, another opportunity. The investment should be in the last thing on your mind now. If you have a 401k, contact your HR department and you need the money, contact your HR department. There should be a way, hardship withdrawal, maybe a 401k loan. I hate to do those, but again, this is a dire situation for you, for your family, if you absolutely need it. Right now, investment is out the window, guys. You need to survive. You need to thrive here. You need to kind of keep, stay afloat, because these government checks, guys, are not coming tomorrow. They still are voting on it. So don't expect that to come tomorrow, Friday, next week, 2 weeks. It's probably going to be months before the government gives a crap about you. So again, you have to kind of look out for yourself. Just a heads up. Okay, leaving it there. I'm going to go ahead and answer some questions now, and not to make it as redundant as hell talking about the same thing, but I kind of wanted to talk about this. So let's go over it together, guys. Crazy times. Yes, it is. Are REITs fucked. No, REITs are not fucked. Commercial REITs are in trouble, so be careful. Thoughts on WFC? WFC, again, I'm kind of going to talk about individual stocks not in a trading range, but more of a sector thing. So he's asking about Wells Fargo and banks. What you have here is a government backstop, meaning the Federal Reserve is saying we'll provide liquidity, meaning money, to the banks. And what does that mean for you if you're a bank investor? Meaning that basically the risk is taken off, but people are going to still sell the bank stocks. So again, personally, I own a bank stock that I like. And again, if you feel to get in, that's okay. Just understand the risk in mind. You're not going to get growth from a bank stock. You're going to get dividends, and they're not buying back stock. So again, it really depends on what your goals are and what you're trying to achieve before that. Dimitri says, should we go for blue chip stocks like Microsoft, Coca-Cola? Okay, I'm going to pause that. And that's a really good question from Dimitris. We're going to talk about what stocks to look for. Yes, I'm going to go ahead and go over that with you. And now that we kind of understood the both sides of if you're laid off and you're hurting, what you should do, meaning call the services and providers, your landlord, all that stuff, like I said. And then you have the investor that, hey, they lost some money, they have some cash, and they want to put it to work, and they're doing fine economically. So again, I want to give both sides, and we'll get there. So I'm going to talk about what stocks I like here and how to play a little defense. Let's see. Okay, the airlines for a while. I feel Pro. Use. Okay, can I get an extension monthly paid off? Joe Pro, if you're extended if you're laid off from your job, you shouldn't be trading options. Number one, just keep that in mind. Your priorities are kind of backwards, so you should leave. Just a heads up, and you can come back when you're ready, boss. Let's see here. What about investing in? Okay, we're gonna go over that now. Talks about bottom and dropping. Okay, so we're going to go ahead. I'm not talking about options here, so please do not ask about options questions. It's not an option webinar, so just a heads up. Okay, let's talk about the macroeconomic sense. Why did this happen? I know I talked about the stock market going down and how that created that wave of selling. Now, what the Fed is doing, what the government's doing to try to mitigate this. And they have a little bit of ideas from 2008. Well, the Federal Reserve released their unlimited liquidity, meaning they're going to do whatever it takes to boost this market, do whatever it takes to provide cash. Well, that sounds great and dandy, and that is pretty cool. But again, it didn't really help markets today. Markets hurt today was the fact that we didn't get a stimulus deal passed from the clowns in Congress. Regardless of what side of the aisle you are, left, right, center, up, down, whatever. The thing is that these guys have a job to do, and they're not doing it. So again, vote however you want. I could care less. But again, they need to work for you. And that's very sad because there's people who are dependent on getting some help and they're not doing it. So again, take that as you will. But again, it sucks. That's just where we are. And I don't want to hold my breath for someone to give us a stimulus package when it's not in our control. What's in our control is that what's in front of us, which is our charts, which is our eyes, and doing our fundamental analysis on what stocks to pick. And that's where we are. So again, fine, leave it there. So you have the Fed providing unlimited liquidity, backstop, providing that. They're buying corporate bonds. What are corporate bonds? I get a lot of questions like that. Corporate bonds are basically corporations borrowing money. They do a bond offering, meaning they borrow money and they offer interest for it. Think of you getting a personal loan on a bigger scale. They borrow billions of dollars to fund their operations, to buy back stock. Facepalm, I know. Or to expand their operations, they want to refinance their debt. They want to hire some more people. Whatever, pick your reason. They just do it. So again, now the Fed, in order to bring down the yield, meaning the cost of borrowing money for corporations down by providing demand because they're borrowing it, they're going to buy corporate debt. Basically, we've turned into the Bank of Japan, who's been doing this for decades, and their economy has slowed down for decades because of it. So again, that's a whole different conversation in regards to economic theory, but it's not a good look looking at it now. So bonds, right? Everyone asks me about bonds. What about bonds, Carlos? What about bonds? Talk to me about bonds. Well, bonds are pretty boring, but bonds are basically lending the government money. You're lending someone money. This is the government. So we look at the U.S. 10-year, which is pretty much the baseline for the world economy in a sense, or the United States economy. And we're about 0.75%, meaning if you borrow today, if you lend the government $100 for 10 years, you would get 0.78% return. That's pretty horrific return. For that, you just put the money on the mattress. But it's the safest investment in the world, basically. The United States is going to pay it back no matter what because they just print the money. So again, why does the yields and the price go down, up and down? They move what we call inverse, meaning if the price goes up of the bonds, meaning there's more demand for the bonds, then the yields go down. Hence why yields are going down. Everyone's rushing to safety. They want to go to something safe. A lot of hedge funds, a lot of mutual funds, pension funds, they need to put their money somewhere. They just can't leave it in the bank. They buy treasury bonds, which are the safest investment on planet Earth. Hence, the yields go down, prices go up. And if you flip it here, and if no one wants to buy bonds, guess what? The price goes down and the yield goes up, meaning they have to offer more return of investment in order to attract more buyers. What happens when interest rates go up? We all know what happens. Your car loan price, car loan interest rate goes up. Your mortgage rate interest rate goes up. Credit cards, yada yada yada. Right. The next thing. What else is the Fed doing? They're buying U.S. Treasuries, which is bringing down the yields, making it cheaper to borrow. The prices of the bonds go up. Hence, right here on the left side here, ZN, which is the US 10-year futures. They were up big, and if you want to take a look at it, I can show you right now. This is a chart of the US 10-year note, and I can bring it up on an hourly chart, and of course it doesn't come up. Let me see if I can bring up a better one. You know what? Best one would be TLT. TLT is the ETF for treasury bonds. A lot easier. And you could see here how much it's exploded since last April. That's on the daily chart for about a year. It's exploded from about 120 to 166. What does that mean? You're getting a lot more demand for bonds because the Federal Reserve is buying these bonds, bringing down the interest rates, boosting up the value, right? So more demand increases the price, lowers the yield, which helps everyone. In theory, quantitative easing, lowering the cost of borrowing so you can borrow more money and you could spend more and buy that boat, buy that car, buy that house, etc., etc. So the next thing, people ask me, well, Carlos, what about my mortgage, right? My mortgage. How come my interest rate on mortgage hasn't gone down the way, the US 10 years? Well, the US 10 year is the baseline for the mortgage rates. So I'm going to go to bankrate.com, and this will give us the current mortgage rates right now. Now, again, I'm not a real estate salesperson. I'm not a mortgage broker. I used to be, but I used to have an MLS number, all that jazz, but not anymore. So we're looking at rates on a US 10 year. Here's the rates right now. If you want a 30-year fixed rate, it's at 3.9%. If you want a 15-year, it's at 3.4%. Pretty good, right? I think, I don't know in regards to timing, how far that's been. Let me see if I get an actual chart to see how long it's been since it's moved. But the real thing that moves the mortgage interest rates here is mortgage-backed securities, and I'm pretty sure you've heard this term before from The Big Short, if you've seen the movie. MBS, mortgage-backed securities. So when you buy a mortgage and you buy a house or you borrow money to buy a house, what these investment banks do, the mortgage company sells your mortgage to the investment bank. And the investment bank pools all the mortgages from your friend, your neighbor, your teacher, your doctor, it doesn't matter. They pool hundreds of these mortgages together, and they're pretty much safe because they're backed by the government. If they're FHA, as an example, they pool them together and then they trade them in the open market in Wall Street. That's called MBS, mortgage-backed securities. And these are pretty high-rated securities. They're put into pension funds, mutual funds, and they make money every single month from your mortgage payment. That's great, right? Well, if you don't have demand for that mortgage-backed security like we're not getting, guess what people are doing? We talked about with S&P, when you're having the wave of margin calls right here, people are selling MBS. They're selling the mortgage-backed security. They're selling everything that's made money, whether it's gold, Bitcoin, crude oil, anything they can make money from, even treasuries. They're going to raise cash. Again, fire sale. They're going to push it out the door. So MBS demand goes down. What's the next to go up? We talked about it with bonds. Yields go up. That's not good for somebody who wants to refinance their house or that wants to buy a house. It costs more now. So what is the Fed trying to do? They're trying to create an equilibrium to make a balance. They're going to buy MBS in order to lift the price of MBS and lower the yield so you can go back to house hunting and refinancing your home equity and all that stuff. So the Fed has their hands on so many buttons They're throwing everything they can at this fire that is the economy right now. But the elephant in the room is the consumer. Again, they can do all this stuff for you. Do you feel richer today? Probably not. Can't even leave your house. You're watching me on YouTube talking, right? Not much to happen. So again, these are the things that they're trying to do. But at the end of the day, until this is done, until we have a vaccine or this is contained, the economy is basically at a grinded halt. Keep in mind, guys, 70% of the economy is service and the consumer and purchasing and spending, all of everything. When you go to your barber and get a haircut, he takes that money and goes to pay his rent, or he pays his car, and that car payment goes to pay someone else. So think of the economy as a candle. Your candle lights someone else's candle. Your candle lights someone else's candle, and so on and so forth. Always. The waitress at the restaurant, the coffee shop clerk, your auto mechanic, your barber, your doctor, veterinarian, everyone, they're all here for the same thing. They're here to keep a life with their money. So again, when you give them a dollar, they're taking that dollar to someone else and someone else and someone else, and it just goes in circles and circles. What happens if you don't spend? You don't get a haircut this week. He doesn't get paid. And if he doesn't get paid, he's not going to pay his bills. If those bills aren't paid, their bills are not going to get paid. And it creates a cycle down the tube. So what do? You can't really do anything if you can't leave your house. There's a silver lining here now, guys. This is where I talk about the investment side. So with that being said, I kind of talked about bonds, MBS. I know it's a lot of jargon, and the Fed and all this, what's going on. Hope I didn't bore you to death. Let's go ahead and answer some questions. Okay, let's see. Thinkorswim, yes. It's a lot. Talk about taxes. Okay, I'm not a tax person. So just a heads up, I'm not a tax person. Just to keep in mind. Hi, Carlos. You show a lot of expertise in financial markets. What qualifications do you have? I used to be a financial advisor. Just a heads up, I used to be one at Citi and BBVA. I'm not anymore because I'm part of G.A.R Capital and I don't have any licenses anymore. Just a heads up. 6 and 63. I was a 6 and 63 in a group one. Not anymore. Okay, ETFs seem to be broken. Should you buy individual stocks? I'm going to go over that now. Again, Thinkorswim. What do you think? I got some 3-verse leverage ETFs. Oh boy. Everything we read tomorrow. I'm not going to answer things short term. This is not a short term. This will be saved for later. Yes. TKK is in reverse. I'm trying to answer some questions that are relevant to this conversation. First, I think it's because our government was too scared to act with force because they didn't want to take the blame for the economic damage. Really good question. Really good answer. Again, we politicize the stock market. That's the problem. We politicize the economy. No one wants to hold the bag, especially in an election year. Everyone wants to take credit, but no one wants to take the blame. That's where we are. I need someone to light my candle. That's good. Mortgage rates go up every February, August, down in September every year. That's not necessarily the case every time. That's more anecdotal, but again, it makes a point. Okay, so I answered questions that are kind of relevant here, and now we're going to talk about stocks you're going to see. I know everything else was boring. Now we're going to talk about what to look for. What do I see? What am I looking for if I'm an investor? Okay, the assumption is you have your emergency savings, you're out of debt, you took a little bit of haircut on your stocks, and now we're going to look for stocks. Great. Well, I have a list of stocks that I have been wanting to play or wanting to buy, and I'm going to tell you them which one I'm looking at and why I'm looking at them. So even better. So this is TD Ameritrade. Again, this is our 10K challenge account. I have it here. And let's go ahead. I actually take a look at some stocks that I do like. A couple things I like looking for. I'm old school. I like dividends. If rates are really, really low, I like dividends because I want cash flow back to me. And that's just the way I am. Again, you don't have to have dividends if you don't like. But again, it's just something that I like. So first one, again, I think everyone likes, is Apple. Again, let's take a look at Apple together. And we're going to go ahead and what do you top long-term buy? That's where I'm going to go right here, Sabit. So here we go. Okay, looking at Apple, I'm going to go ahead and talk about some stocks here that I like. Feel free to take a pen and pad, and we'll go over it together. Apple, I just heads up. This is a disclaimer, excuse me. I own Apple stock. I think everyone does, but I own it. So let's look at Apple in comparison to the S&P 500. Apple in 1 year, in 25-year period, 1 year period, 52 weeks, is still up around about 20%. And it's beating the market, which is actually down about 10%. So Apple has definitely outperformed. So a couple things here when I'm looking at the page, it's a couple things I want to see. I want to see EPS growth, which is earnings per share. I want to see PE ratio. PE ratio to you should be the actual price, the price ticker. Like when you're actually at the store and you look at a TV and you're like, oh, how much does it cost? It should be the PE ratio. That should be the first thing you see. So the PE ratio is probably to me the most important thing. We live in a weird world now that as stock prices have gone, they may have gotten more expensive. How does that work? Well, if you don't have earnings, you don't know what their earnings are, how can you price them? Right now, stock PE ratio for Apple is 18 times earnings. So that means you're paying $18 for every dollar earned from them. That's what we call a premium, or premium on the price multiple, right? So how do we base that? Let's look at the PE ratio for the S&P, which is the market. And that'll give us a really good kind of an idea of where we are. So right now I did the PE ratio. Right now we're about 16 times, 16.84 for the broad market. So you're really paying about what, $2 premium above market for Apple, a great company with great cash. How do I know they have great cash? Well, I can look here. Look at the cash flow on Apple. Look how much income they make. Tons of income. Their EPS growth is at 13%. Revenue is up about 7%. Their dividends up about 10%. Cash flow is there. Balance sheet is absolutely tremendous. They have money. They can weather the storm. So let's look at their income statement and balance flow. You could see their operating income. It's absolutely off the charts. Great income. Total revenue is great. What more can you look for a company? So what you can do here is you can actually do a peer comparison on TD Ameritrade, and you can take a look at other companies in comparison. So 52-week change are up about 21%. Their market cap is just a smidge below 1 trillion now. Their dividend yield is about 1%. But again, they don't need to fight for dividend because they're going to get your money anyways. They're a great company. 18 times earnings, kind of a high multiple. But again, you're paying about $2 more per. But again, it's a premium company, so it's kind of worth it. Their margins are absolutely ridiculous. From what they purchase or what they make for how much they sell it, I mean, it's Apple, right? 21.5% is their margin. That's pretty unheard of. That's pretty great. And their earnings growth is about 13%. Revenue growth, again, about 2.32%. It's pretty solid. Not amazing. You're not going to get these aggressive growth like a Netflix. But Apple is a fortress on a balance sheet. They can buy back stock. They're not going to get a bailout from the government. They don't need it. So they're not going to have that kind of a restriction on them like the way the airlines are going to have it or the banks are going to have it, because they're pretty much their own island. They have what they need. So again, you don't need me to tell you how great Apple is. Again, that's a name that I would nibble on and that I have. So again, what does it mean by nibbling? Nibbling is buying stocks on the way down on pullbacks, meaning if the stock goes down today, like for example, Apple did today, Apple was down 2% and actually bounced at the end of the day. It was down about 4% during the day. That'd be a good time to actually start buying a little bit. But again, I have a target for Apple for me right around $210. That was an actual level I was looking at, was that if we broke 210 around $200, that'll give me that price target that I've been wanting. So think of it when you're buying investments like you're buying a car in a sense. What's the price you're looking for? What's the price you can afford? Kind of have it in your head. If you want to say, I want to buy $500 worth of stock, okay, what stocks do you want to buy? How many shares do you want to buy? Is that your budget just for one set of stocks? Don't buy all in one shot. As always, I've talked about that with our personal finance course. Buy it in blocks, meaning that if you want to buy 50 shares, you don't buy 50 at once. You buy in blocks. You buy 15, 15. That's 30. Another 10 and another 10. You kind of break it down like that. Don't do all at once. You want to cost average your price out. Let's say you bought 25 shares at one shot and the stock goes down another 4%, and you still have another 25 share block. Guess what? You average down. Or let's say if it goes up and you buy another 25 shares, it's not the same thing. So again, it kind of mitigates the risk of just buying all in one shot at one price. You want to kind of nibble. That's what we call it in the investment group. We nibble a little bit. CNBC likes using the term too. We like to nibble on stocks, meaning want to buy a certain amount depending on your portfolio. I want to buy Apple. I buy a couple of shares. So what I do personally is that I buy them in $1,000 increments. I'll buy $1,000 worth of Apple at one shot, and I'll do the $1,000 of Apple another week or whatever time I want, or I'll break it down. That's just an example. That's how I do it. So again, that's a name that I like. Let's go ahead and answer some questions here. I know I had a bunch here. With low mortgage rates, do you think people will buy more? Yes, of course. Won't this cause massive inflation? Inflation's a really good point, but again, the United States is still the best house on a bad neighborhood, meaning what other economy do you want to use? You want to use yen? Do you want to use Swiss francs? Do you want to use euros? The United States is still the reserve currency for the world. Will we have inflation? Of course we will. That's inevitable. Actually, we've had a little bit of deflation. But again, this is a crisis. Well, it's kind of like, hey, we're gonna go ahead and rip the kidneys from your body to save your lungs. It kind of sucks, but you have to pick your poison here, guys. From what I hear, things are about to get bad here. He took measures today. I don't get it, man. If all the countries just have ties with China for a while, things will get better. Well, we're not going to talk politics there. I mean, I don't know. I'm not the president. But again, when you say bad, things get bad from worse, it can. Sure. If a lot of people die, things can get worse. And we're here talking about investing. But again, I'm trying to look at it as a way to what do you do here moving forward? Do you see a bubble? Oh, Mark, man, the bubble's already gone. The bubble's bursted. It was a basically high leverage, a debt bubble is what we were. Um, this is the debt bubble, guys. Retail and commercial real estate. I mean, people need a place to live. I understand residential, but commercial, if you're not paying your bills, you're not getting consumption, they're not going to pay rents. Commercial real estate's going to take a hit, guys, and retail too. Could high cash flow show Apple marginal products really that low though? The marginal return on investment was high. They would invest it. They do invest it. They buy back their own shares. Just a heads up. What platform do you do buy shares? I do buy TD Ameritrade, and I'm doing the long term right now. Statistically though, isn't lump sum more effective given the market's more likely to definitely from the price than fall below it? Again, you can't now you're just trying to time the market. And that's difficult because let's say you went a big position into Apple and that thing drops another 20% on some really BS headline. Now you have to make up that 20% back. If you would have just done it in nibbles, then you'd have been smarter off. Again, be a smart shopper. Don't be an emotional one. Again, don't go all in. Takes time. Takes time. 2 weeks from now. I don't know what 2 weeks from now is. Thoughts on Jpmorgan stock? I like Jpmorgan long term. I actually bought some. And to me, that's the best of all the bank stocks. They have the best balance sheet and the best management. That's the one I want to do. SPXU. Okay, let me see what SPXU is. Okay, these are levered ETFs, ultra short. I'm going to skip that. That's a trading thing. That's not an investment thing. Just a heads up. Okay, so we did Apple, right? That's a couple of names here. Now, one other name that I like, and I know pretty much everyone knows about, is Microsoft. And Microsoft, I'm going to put in the same level as Apple. They've held up in comparison to the S&P, as you can see, up about 19% against 20. What do we look for? PE ratio is around 25. It's a little more expensive than Apple. EPS is pretty solid. But if we go take a look at the fundamentals, you can see EPS is up 7.7%. They really don't have a ton of retail presence. Sure, there's Microsoft stores, but everything's on the cloud. 12.5% on EPS, and dividends up about 10.96 tons of cash. If we did a peer comparison to other companies like ServiceNow, VMware, Norton LifeLock, or Proofpoint, for example, their PE is a lot cheaper. Their revenue is a lot higher. Their margin is a lot better. Their earnings growth is up there. Their revenue growth is up there. You're going to get a lot of value from that kind of name. So again, that's a name that you kind of want to start nibbling on. Now, how do you do it? When do I start buying, right? Good question. Well, that's where you start taking the daily chart. I have an alert here at 130.91 to buy some Microsoft. Again, I want to get that level. You could see 130.91 is really right around August of 2019. That's a pretty decent level. If you want to go ahead and bring it up to a weekly chart, you could see right there, it's kind of that support, kind of that breakout level from this base. So if you're looking at technicals, 130.91 tends to be a good level. It's a little above the 100-day moving average if you're a technicals guy. So again, nibble in, lowering. Again, it's almost like you're buying in as it gets lower, and then you have that actual stock and supply, and then it'll get raised in value. Again, this is only if you don't think the world's going to end, guys. Keep in mind, if you think the world's going to end, just buy ammo, buy water, and hide in your shelter. That's fine. But again, we're talking to investors that are looking at this as an opportunity. A lot of hedge fund managers, guys, are buying. A lot of rich individuals are buying. They see that as a time as value. I'm sorry, I don't think Microsoft should be down 30% from its highs in 1 month. That doesn't make sense. That's people who are forced to sell. So what we say in stocks is that sell when you want to, not when you have to. That's what happens with leverage. Leverage is bad. This is what happens. Okay. Generally buying at any point without intentional timing. Okay, that makes sense. Brent says, will there be a rush to safe haven similar to 2008 when TARP was announced, or have we become numb? I think the rush to safety has already kind of happened. There should be some more rush to safety. But again, the Fed has kind of made us numb. So investing at any time is you better lump sum in DCA. Again, I do DCA. That's just me, dollar cost averaging. AT&T, I own AT&T. I like the yen, the dividend yield. Again, it fell a little bit today. AT&T, guys, is a media company. Again, they own DirecTV. They're going to be a 5G play. Keep in mind, they're also a cell phone company. What's the last thing you're going to sell? What's the last thing you're going to cut off when you're at home quarantine? It's going to be your cell phone company, guys. That's the last thing you're going to cut. They were downgraded by Baird today. That's why, hence they were down. Price target from 41 to 33. I bought some last week. It's at $27 a share after hours. Their dividend yield is right around 7%. They have the money to pay that. I don't think 7% is going to happen, but again, they have the money to pay that. So if we look at the fundamentals on an AT&T, again, EPS is decent, revenue is decent, they have cash flow, they have income in their revenue. They have the good balance sheet too. I mean, they started raising cash. The only thing is that they were a little levered. I mean, they were a little bit in debt, but their CEO has been unloading assets. And for example, because they took over DirecTV and Time Warner. But again, with media and what's going on, people staying home, think of it as the at-home economy for right now. They are pretty much well diversified with cell phone and media. I mean, they have Time Warner, all that stuff. People are going to still watch CNN. If you're into CNN, again, DirecTV, you're not going to cut out DirecTV when you're home, all day not working, as an example, working from home. So again, I like AT&T as well. Dividend producing stock, what is too high of a yield? Too high, Ethan, I would say point of reference, we're probably around 9%. Perfect example. CenturyLink has been one of those guys that have been a tease for yield, and it's always done that. So imagine, look at CenturyLink, right? CenturyLink is communications, and 10% yield, and they pay this yield, by the way, right? For the past 3 years, they've had about a 10% yield. But look how much you're losing in the price of stock, 60% in 3 years. So all that loss in equity is not offset by the dividend. So it's kind of pointless. What you want in a dividend company is that they're kind of flatline, they're not growing, but they're paying you. Think of it like as a bond, but again, or a CD. But CenturyLink is like this, big drop in their stock price, but they're paying you a 10% yield. You're negative 50% at that point if you kind of do tangent for tangent, which is not. But again, it looks pretty ugly, guys. That's why these are what we call dividend traps. Anything that's above 9%, a lot of energy companies are there. For example, Oxy, I think it's Oxy Petroleum. I think they paid 30% dividend, guys. No one's going to pay you a 30% dividend. I'm sorry. And if they do, they should be bankrupt. First of all, they're down 75% year to date. We know with oil. So again, that is something I really want you to be careful of, is these dividend traps. These companies, energy companies that are highly levered, Oxy Petroleum, I don't care who's buying it. 75% drop. Another one, Marathon Oil, pays only a 5% yield, and they're down 75% in 3 years. Guys, energy is getting crushed. I've been telling you guys for months now, stay away from energy. If there's an energy company that you want to buy, gun to your head, oh my God, I have to buy an energy company, then it'd be ExxonMobil, if you had to. And their dividend yields 10%. I don't think they're going to pay it, but look at their revenue, guys. EPS is down 15%, revenue's down 8%. Their high was 95 in 2016. They're down to 31 now. It's ridiculous. They have a great balance sheet, yes, but they're going to spend all their money on dividends for 10%. It's horrific. Yes, technically it is cheap, but don't buy stocks because they're cheap. It's like buying green meat at the 99-cent store. Sure, it's cheap, but your body's going to hate you afterwards. Not really worth it, guys. How do I compare stock price and MACD? I don't use MACD, just a heads up. Who is talking about right now? My computer will learn at the moment. Real question, why are you using Firefox? I love Firefox, first thing. How will commercial real estate be affected by this? Okay, let's look at it from a macro perspective. You're a real estate investor, and you own some commercial property, and people, nail salons, office, whatever space, they're not working. They're not getting revenue. How are they going to pay you? Right? They're not going to pay you. They're not going to pay you. That's not good. You're not going to get revenue because they're not getting revenue. So you're going to get in a point, I wouldn't say a bubble, but a lot of landlords are not going to get paid. I remember when people would say, oh, real estate is safe. Real estate is safe. Cash flow properties, cash flow properties. Yeah, man, cash flow properties are great when they pay you. But if that guy loses his job, what happens? At least with stocks, again, I don't own any real estate. The only real estate I own is Fundrise, which is a real estate investment trust. And I'm all my money in there. Again, I have some money in there. So I get interest from that. But my money is mostly investments in the stocks and my companies that I own. But again, if you have a single family dwelling, it's worth $300,000, and your renter's paying you $1,500 a month, whatever. They lose their job, how are they going to pay you? And guess what? You still have to pay the mortgage, don't you? Well, let's just say you call a mortgage company. Yeah, again, how long is this going to take? Let's say you have apartments in an apartment building with 30 rooms or 30 doors, meaning 30 tenants. No one's going to look for a place now. People are out of work. This is a recession, guys. It's a recession. Bottom line is a recession. Real estate, guys, the problem is that people are so highly levered, especially those real estate investment trusts. They have to borrow money in order to buy these properties. If they don't pay the notes, they're in trouble. A lot of these real estate guys you're seeing on Instagram, a lot of these real estate gurus, they're going to get hit if they were highly leveraged. The smart ones had a really good cash position and to weather the storm. There's a lot of smart ones out there. But again, they're ones that are just way too risky. They borrow too much money. This happened in 08. It's a cycle. Again, cheap money, easy money hurts you at the end. That's why I tell you guys, it's cash, cash, cash. I've been saying it for the personal finance course. Have your emergency savings, have cash ready to go. Stocks are pretty liquid, guys. If I want to sell my portfolio tomorrow, I can still get cash back. Bitcoin is still pretty liquid. Again, I have some Bitcoin. I could sell tomorrow. Again, at $6,600 right now per coin. I have some gold, some actual gold coins. I can go to the actual jewelry store or pawn shop and sell it and get rid of it. Again, things that are not as easily liquid, art collection, your Michael Jordan rookie card as an example, autographed jerseys, memorabilia, real estate. Real estate, it takes a while to sell. Doesn't sell right away, guys. Just a heads up. Oxy cut their dividend. There you go. Further drop of 15% possible. Absolutely. Okay, so let's see. It's Supreme asked me if I'm a millionaire. No, I'm not a millionaire. I'm not a millionaire. It would be awesome if you had a class on how to build an income portfolio. Yeah, I could probably work on that. Let's focus on what we have here. So we talked about dividend creep, dividend traps. We talked about stocks that we do like, a couple of them. Again, good balance sheets. AT&T I like. I've added because I want that dividend. But they have the money to pay that. Just a heads up. Yeah, Grant is in trouble. Who's in trouble? Oh, Grant Cardone. Again, I don't know about his money. Again, I can only talk about your money, guys. I don't know. Again, there's a lot of real estate guys that may be in trouble due to their heavy leverage positions. Who knows? Again, we're worried about us, guys. We're not worried about anyone else. Like my teacher would say, keep your eyes on your own paper. So let's go ahead and answer some more questions. Beyond Meat. Okay, so let's answer Beyond Meat. Again, I'm assuming is an investment. Look at Beyond Meat in comparison to the S&P 500. It was a great story for a little bit, but again, guys, let's kind of break this down. You're a vegan, right? Vegan food costs a little more. They cost a little more, right? But you went out of a job, you're not going to buy vegan food. I don't care who you are. You're still going to eat McDonald's. Whatever's cheaper, you're going to get that regular ground beef. So Beyond Meat, and I've been to Target, I've been to the grocery stores, and I see Beyond Meat left there. No one's going to pay a premium for beef that's not beef or fake meat because they're vegan when they're broke or they're hurting for money. Forget vegan. I don't care if the cows are sad when they get slaughtered. You gotta eat. Okay, I don't care if these cows were massaged before they went to the slaughterhouse. You gotta eat whatever works for you, meaning more ground beef, more rice, more beans, more mac and cheese, whatever it takes to survive. You ain't thinking about Beyond Meat. That right there, guys, is what we call consumer discretionary, meaning it's up to the consumer's discretion. He ain't gonna buy that stuff. Right now, if you're laid off, you ain't buying no Louis Vuitton right now. I'm pretty sure. You're not buying no Gucci and you're definitely buying no Beyond Meat. You're probably not gonna buy any Starbucks coffee. You're gonna make coffee at home. That's a discretionary. It's an example. Again, that wouldn't be a smart one, especially in this kind of times. Just a heads up. Let's see. What do you think about Altria and Philip Morris? Again, that's nicotine, cigarettes, whatever. Again, looking at the stock again, guys, another thing, are people going to smoke during the economy or during this little recession that we're at? And we are in a recession, guys. Remember, electronic cigarettes, what was it? That'll be Altria, though. Juul has been really, really, really regulated. Altria was great for a little bit, but then it took a dump. It's down 40%. I don't recommend it long term. It's a tobacco company. They consider it a staple. I don't. Cigarettes have gone away. The only thing I would say that would bail out an Altria would be cannabis being legalized, which I doubt. Maybe one day they do it. Planet Fitness, someone's asking, guys, gyms are closed. No one's going to go to the gym right now. Stay away from that company as well. So again, Facebook, anyway, this virus thing has affected the company in a negative way. Facebook is a company that I own as well. Great balance sheet, and let's compare them. Again, Facebook has done better than the S&P. They're a virtual company. There's very little lower overhead and extremely, extremely attractive margins. What does that mean? Meaning they really don't have to spend a lot of money to create their content because the content is coming from you. Their EPS is up 42%. The revenue is up 41%. This is a company that's hated. In my opinion, they're like the tobacco companies of the 80s and 70s where everyone hated them. Again, we know their privacy issues. Guys, if you care about privacy, you wouldn't be on the internet. So let's just make that very clear. Facebook, you're going to use regardless. Facebook, again, their 52-week change is down 9% compared to everyone else, right? Look at their margin, 26% margin. It's absolutely insane. Earnings growth is up 42%, revenue growth up 26%, and their total revenue is $70 billion. That's great. Their market cap is nearly $500 billion. Their PE ratio is right around 24, a little more of a premium to the S&P. I think that's a buy. And if you want to take a look at the chart, Facebook, we'll do it together. They have tons of cash in their balance sheet. They have no debt. I like a chart right here, 123 as the market goes down a little more. If it gets down to 123, I'm buying it, and I'm going to keep on buying Facebook. Perfect, a perfect example. Any comments on the precious metals due to the limited supply of money coming from the Fed? That's a really good question, right? We talked about gold. You would think, we talked about that earlier, why wouldn't gold go a lot higher? Well, guys, people are selling off gold in order to cover their margin calls or their losses in their portfolio. I still like gold long term. I own some gold. I do not own any gold ETFs. If you wanted to buy gold, GLD would be the one. I do not own any GLD. I just own gold coins in my safe. That's a way to play it here, guys. GLD, or you can do Barrick Gold, which is actual gold. They're a miner, and they're at $16 a share. If we went ahead and brought it up, let's look at Barrick Gold. I just want to make sure that they're not highly levered, meaning they have a lot of debt. And let's look at gold here, summary. Mining industry, gold is actually, Barrick Gold in a 4-year period is up 20%, outperforming the S&P. Their PE ratio is at 7, which is very cheap. And they actually paid a good dividend of 1.76. So far, so good, right? Barrick Gold. If we compare them to CDE, Core Mining, and you could see their PE is around 7, market cap of 28 billion, profit margin at 47% margin. That's actually pretty solid. And revenue growth is right around 34%. So they're actually doing pretty well. And I would actually like this actual stock to buy on a weekly chart, or let's bring up a daily chart. You could see it's pretty much right there at 200-day. Looks like a pretty cheap buy. Again, if you're thinking of them going long term, and gold is actually Rand Gold, not, is it Barrick Gold or Rand? Yeah, Barrick Gold. They have it under Rand. It's actually Barrick Gold. $17 a share. That's actually a buy. I'm gonna write it down. I'm actually gonna go ahead and buy this stock probably tomorrow. So gold it is. I'm actually gonna buy some tomorrow. How fun is that? Let's see. Boeing, why did it go up after they shut down factories? Because they're saving money. Yes, Boeing, guys, I get that question a lot. Guys, don't try to catch a falling knife on Boeing. We don't know what else they have going on. They could be to the point of bailout. They could be bailed out. We don't know that. But again, do you want to test that water? So let's be a little more of a perspective here. When do you start buying? There you go. We'll wait for it to go up before we start buying, right? So you know what level I'll start buying here, guys? Right around 157. If we start breaking back up 157 a share, again, I'm willing to lose a little bit of profit in order to buy. 157, I will start nibbling. Once we get back over to 236, then I'll add a little more. And then once we break that 200-day moving average around 270, 280, that's when you start buying. But again, if you are so hell-bent on buying some Boeing, fine. But again, I'd wait for 157 before you do anything. Not now, because we may get a little more downside. That's just what I see, because we don't know what's in their books. I'd rather wait for their earnings personally. Silver, I own silver. I own some silver in my safe. I do not own any ETF silver. I prefer gold instead, just a heads up. Snapchat, stay away. Snapchat, I don't know why they're in business. I'd stay away. Colgate-Palmolive, I own that stock. It's CL. Colgate-Palmolive, I do own that. I made a purchase on that. And let's look at it. Again, it's a consumer staple. They pay a dividend of 2.84%. PE ratio of 22%, a little higher. But again, like a Procter & Gamble. And they're actually cheaper than a Procter & Gamble. Procter & Gamble, remember we talked about PE ratio. Look at their PE ratio, guys. 56%. You're paying $56 times, $56 per dollar earned. For that, I can get CL way cheaper, which is Colgate-Palmolive. Same industry, household products, 22 times earnings. Let's do the peer comparison. They should be comparison PG, perfect right there. Now, PG has held up a little better against CL, sure, but the yield's basically the same, a lot cheaper on the PE. Now you're doing comparison shopping here, guys. Look at the revenue. Sure, CL has less revenue, but their margins are better. and they have better earnings growth. The only thing is revenue growth is a little less. So again, I'm getting better earnings growth. I'm better margin. Sure, I'm getting less total revenue, but the PE, I'm getting a better value from a Colgate-Palmolive, which is basically the same thing for Procter and Gamble. Unless you're a really big Crest fan and you hate Colgate, and that's fine if that's the case. Buy what you like, I guess. But again, 16% profit margins. I love that. I'll take that to the bank. I bought some Colgate-Palmolive and I own it and I plan to own it. And there's other names too. That any of these names here, guys, I like. Clorox, Kimberly-Clark, Procter & Gamble, Colgate. You're still gonna brush your teeth. You can use Clorox wipes, especially now. Kimberly-Clark, you still need to use napkins and all that stuff, paper towels forever. That's never gonna change, guys, no matter what recession we're in. So again, this is what we call consumer staples. Consumer staples, utilities, for example, like Con Edison, those are great. You want to use dividend stocks, those are great too, like a Coca-Cola, like a Pepsi. Those guys are going to pay you to own their stock. Those are kind of like your three prongs, recession proof your portfolio or recession shield your portfolio, I'd like to say. Utilities, consumer staples, and dividend stocks. Those are your three. And stay away from energy, stay away from growth, aggressive growth right now. Three long-term dividend stocks, easy. Verizon, Coca-Cola, and AT&T. Those are your three. Let's go through Qualcomm. Okay, Qualcomm, I actually like. That's a name I've been looking at. And Qualcomm, again, with their chips and everything like that. Again, aggressive growth, 52-week change, up 6%. I went straight to the peer comparison, up 17% times earnings, a little cheap on the PE ratio. I like that. Earnings growth is weak, revenue growth is weak, but their margins are nice. They are great. The good news is that Qualcomm had a lot of cash on the balance sheet, which is really good to me. What gets me nervous is the revenue is declining and the EPS is declining. Again, they're a chip maker. If you believe in chips long term, I like Qualcomm. They have a better balance sheet, but there's probably better growth names. Another one would be AMD. Again, that's a better growth name, but you're paying the premium to own it. For example, the PE ratio of 137. That's semiconductors. Another one better than that, NVIDIA. I like NVIDIA long term. Tons of cash on their balance sheet. They're cheaper on regards to the PE ratio. EPS is up 32, revenues up 18, dividends up 13, total cash flows through the roof. I like that. If you want to go to peer comparison, again, you can see them compared to an Intel. And Intel, in my opinion, is cheap. But again, NVIDIA actually gives a slight dividend. Intel does a little more. Qualcomm gives a better dividend. The PE ratio for NVIDIA is a little higher than a Broadcom, than an Intel, than a Qualcomm, but their margins are better. Their margins are better than a Qualcomm, but Intel is better than NVIDIA. But earnings growth beats them all except for Broadcom. Revenue growth is negative though. It's just like Qualcomm. So again, you have these five names here: Intel, NVIDIA, Texas Instruments, Broadcom, and Qualcomm, and AMD, or a Micron. If I had to pick with all these, I'd pick NVIDIA. I do not own NVIDIA yet. That's a company that I do want to buy. I have not bought it yet. If you want to take a look at NVIDIA on a chart, this is an actual alert I have, which is right on the 200-day moving average. It's $171. I'll pull the trigger, 172. What about a car company? Right now, guys, car companies in a recession, no one's buying a car. Just keep that in mind. So car companies, the only one I like is Tesla, because people that buy a Tesla tend to have a little more money. People who buy Fords, for example, everyone's talking about Ford, they tend to be on the other end of the income scale, a little more middle class. Tesla people, they have a little more money. They can weather the recession storm. Ford, I mean, not everyone's going to buy trucks right now during a recession. And we are in one, guys. Remember that. We are in a recession. Stay away from Ford, in my opinion, or GM or Toyota, any of those guys. Rental cars, forget it, guys. Rental cars are trash. You can move on. No one's traveling anyways. Where do I get my basics on stock investments? There's a ton of great ones. I'm going to show you this book that I talked about. Here you go, guys. The Guide to Investment Strategy. If you did enjoy this video, I know I couldn't get to all the questions. Take a look at this book. This is the investment guide to investment strategy. Talks about risk, market rewards, and behavior. It's a great book. I highly recommend it. It's from The Economist books. It's anywhere on Amazon, Barnes and Nobles, if you can get into a Barnes and Nobles. But Amazon has it. They also have an audiobook or an ebook. I highly recommend this one, guys. So again, I couldn't get to all the questions, guys. We're basically wrapping up. I hope this webinar helped. But if you have if you want a little more research into stocks and how they work, bonds and everything like that, in regards to like financial markets and how to tailor an investment strategy to you, Everyone is different, guys. I can't give you guys a blanket statement on what to do. I don't know your personal finance levels, your investment risk tolerance and goals. But what I can tell you is that there's always a book to read. There's always something to research. So I highly recommend Guide to Investment Strategy by The Economist. It's a really great book. It's one of my favorites. There's tons to read in here. Allocations, bonds, everything. Everything is in here. Are you in it for the long term? Advice and investment strategy, our alternative investments, credit, equities, you name it, they got it. And I highly recommend that you check it out, guys. So we'll go ahead and leave it there. I know it's tons to get to. I can't answer all the questions. I was trying to break this down as much as I can. I wanted to do this for an hour, but yeah, man. So I appreciate your time today. I hope this webinar really helped kind of break things down. Again, guys, things will pass. Things will get better. Right now, obviously, futures are up again, but that's just futures. Anything could change. We're gonna get through this, guys, together at the end of the day. And I wanted to make this as a way to give you some hope that things will get better, to look forward to something, not just be looking down constantly at the world's ending, because it's not. And things will get better. There's still some hope out there, and we'll get this together, guys. And I don't know exactly when this will change. I hope one day, pretty soon, we can get out of our houses again, go to our local bar, local coffee shop, and enjoy each other again. This social distancing kind of sucks, but this is where the reality we are in right now. But have no fear, things will get better. And about a year from now, I'm pretty sure we'll sit back and just think about, oh my God, remember that time we were home quarantined together and it really sucked? Well, I really appreciate being together now and we're not sick and we had to travel. And think of it, guys, think of it this way. When things get back on track, and they usually do, imagine the demand to travel. Imagine the demand to get out of the house, to go to the local bar or restaurant. I'm not saying things will go back right away, but there's going to be a lot of pent up demand, a lot of money saved to want to go out and do your favorite things. Go to the mall shopping, get some fresh air, go to that baseball game, go to that soccer game, basketball game, go take that trip. I mean, if everyone's want to get out of the house, man. We've been out of the house now, what, 2 weeks? And not everyone's having a good time yet. So we'll leave it there, guys. G.A.R Capital FXs.com is the website. Not here to sell anything. This was just for free to help you guys out. Took an hour out of my day to kind of explain everything. And just want to take the time to say I appreciate you guys, the followers. You guys are great. If you have any questions, feel free to DM us on Instagram, or you can hit us up on Twitter at G.A.R Capital. Make sure to like and sub our channel. A lot of free, cool stuff. And we'll go ahead and leave it there. Have a great rest of your night, guys. Thank you so much. If you liked this video, make sure to like, comment, give us a smiley face, a heart, whatever you want. Have a great rest of your night, guys. Appreciate your time. GARCapitalFX.com is the website. We appreciate you all.